Welcome to the Money Pig Podcast, presented by Goodwin Investment Advisory, where our mission is to lead you to financial pig, peace, independence, and generosity. I'm your host, Tim Goodwin. Welcome back to the Money Pig Podcast. I am super excited. I always say super excited because I really am, especially when I have an incredible guest. As usual, Justin Pitcock, Elmer Fudd. Excited to have you back here, Mr. Fudd.
Thanks, man. It's been too long.
Too long. Actually, remind the audience why we call you Elmer Fudd, in case they haven't heard this before.
Right, so it's because I'm special.
For sure.
I'm just kidding. It's because I love to hunt. And quite, I guess as other people would say, successful. And anyways, I love to hunt, fish, and actually been doing some, trying some new things. And recently just got to go with some guys to hunt bears and hogs with dogs.
How many dogs are we talking about here? Like 2-3 dogs?
They had like 30 dogs. It was 3 truckloads of hounds.
Wow.
And it was a really cool experience. But we rode drove some forestry roads. And when those dogs smell where a bear crossed the road, they go absolutely nuts. In fact, these guys call it a blow up because the dogs literally just go wild. They let the dogs loose and the dogs trail the bear, pig, whatever it is. And it's more of like a sport, a social sport. Like they're not actually going to shoot the bear or the hog necessarily, but it's these, people just get together, watch their dogs.
It's like catching a fish and throwing it back.
Kind of like
found
that.
The bear.
They tree the bear. It's like, all right,
that's up in the tree. Yeah, success. Check it off. Wild. I get frustrated when like my 2 dogs are barking for an excessive amount of time, but like 30 dogs barking. I don't know.
It's pretty cool.
But I bet you can hear them from pretty far away.
Oh yeah.
Like I think you were telling me the story. They've got like GPS collars on them, so you're tracking them. But
that's right.
So probably also hear them.
All these guys, every dog's got a GPS collar, and they're generally all together unless they run into multiple animals, and then maybe some dogs are chasing one animal, the other group of dogs is chasing a different one. But so these guys are just like watching the dogs on their GPS. So they've got like a Garmin, and they've got all the
like little dots, and they spread out, and then they converge all of a sudden.
And pretty much,
that's so
and
cool.
When they tree the bear or bay the hog, whatever it is, like it's the GPS like signals like, hey, the dog's not moving anymore. Like it's time to get in there.
Wow.
And so they'll go in there and call the dogs off if it's they treat a bear because it's especially this time of year, it's not bear season.
Gosh, I hope you're going like early in the day or late at night because it's stinking hot right now.
You start early in the morning, first light.
Gosh, up in the Cahutta, man, that's beautiful.
Yep.
Beautiful country up here in Georgia. So, but as Elmer Fudd, you're not really going after those rascally rabbits. Or what do you say, wascally rabbits?
Wascally rabbits.
Wascally rabbits. Right. Yeah, it's more about the wascally bears and pigs and fish. And that's awesome. Well, you know that I'm more of a runner than a hunter. That's how I get my exercise. But decided lately to stop giving money to people for marathons because they just take my money and run.
Bum, bum, bum.
I got a little smile. Oh, Angela's starting to laugh. Okay, she had to let it cook. Let it cook over there. So, all right, maybe we should get into the topic of the podcast.
So
but
what are we
honestly,
talking about?
That was super interesting. So we're talking about things that you didn't know a financial advisor could do for you. Okay. And we've started kind of having this concept because I think, like, let's start with the why, right? I love to start with the why. Why are we sharing this on a podcast episode? And I think there's some very typical things that you might think about hiring a financial advisor for: planning retirement, helping you with your investments, right? Yep. Of course. What's really cool though is that we even consider ourselves life advisors, right? Like there's so much, like money's tied to your heart. It's tied to so many things. There's so many financial decisions to make. And if you hire a certified financial planner, like what we are, right? Yep. We are very well educated and therefore tested and interested in more than
all things personal finance.
Okay.
Like it's very comprehensive.
Absolutely. So comprehensive meaning like not just investments and retirement planning, but estate planning, tax planning, insurance planning, helping you understand your benefits packages.
That's right. College planning. Yep. It covers,
keep going. Yeah.
I mean, all aspects.
Right. So I think that there are times where we're meeting with clients and they're like, wow, I didn't know you could do that for me. And ultimately, like why I started this company, why we find so much purpose and enjoying it. Obviously ties to the pig, leading people to financial peace, independence, and generosity. Quick nod to the notorious PIG. Is he coming in really good in the shot right there? Okay. But it's also that we want to remove financial anxiety.
I need to get some hounds on that sucker.
You need to get some hounds on that pig? Absolutely. But we realize that there's financial anxiety. Like financial anxiety is a real thing. Everybody's dealing with that, with making money, with making financial decisions. And so I think it's just really cool that we can really intelligently, with experience and education, talk to our clients about any financially related decision that they're going through, even if we're not paid on it. We're obviously paid on the planning, on the insurance. We don't get paid on insurance, to be clear, on the investments that we manage. But that compensation doesn't limit our advice. We really like to kind of help clients make better financial decisions, feeling more equipped about it. So let's dive right into that. Let's get to this first question, which I know is one of your favorites. And if you're a regular listener on the Money Pig to an Elmer Fudd conversation, it can often go to a tax situation. So he's our resident expert on taxes. But share some recent stories maybe around how you have helped your clients here with tax strategies, saving taxes, that kind of thing.
I've got a ton of stories, but so the most recent, there's a couple, they recently got married. Well, recent as in a couple years ago. And they always, filed their own tax return. So they got married and they were like, well, I've been filing a single tax return. So they just started filing married, filing single. And
separately.
Married
filing
or
separately.
Separately.
Sorry. Gotcha.
Thanks. Yep.
Both starts with S. It gets confusing.
Yep. So anyways, it came up in conversation because we were taking a look at their tax return. It started because the husband said, "Hey, Justin, can you help me figure out why I owed so much more in tax this year
interesting.
than the prior year?"
So you guys actually offered this comparison, right, of the year before versus last year's?
Yes.
You did that's super cool.
We got his tax return, the 2023 and the 2024, compared the two, and we're like, okay, well, here's the things. And I noticed it's like, gosh, you're filing married filing separately. Like, probably if you file a joint tax return, there'll be some savings, but let's check this out. We don't know that for sure. So we got the wife's tax return, put the two together as if you were filing jointly, and realized that it would save about $10,000.
$10,000.
So
if they had done that last year, like in 24.
Yes. And so you can amend your tax return for this back 3 years.
Wow.
And so we're going to look at the 23 as well.
You could buy like 30 hounds with that much money and go chase bears.
Well, a well-trained hound is like $8,000 to $10,000.
Oh my goodness.
They're very
just kidding.
Expensive.
Wow.
Now these guys don't buy them well trained. They train them themselves and breed them themselves.
That's what expensive.
Anyways, so
$10,000 last year.
10 grand last year.
So essentially that much this year. And so what are they going to do?
Well, I mean, hope they amend their tax return. We're going to look at the 23 and they'll probably amend the 23.
So at this point, they can literally go back, redo the 24 return.
That's right.
Amend it, file married joint, right? Married filing jointly.
That's right.
And just get a 10 grand check from the government.
Yep. And guys, if y'all are listening, we do accept tips. Just kidding.
I was like, make sure that disclosure is really clear at the end of this episode. Yeah, that's funny. Wow. So that's enormous. Probably not something that folks are thinking financial advisors will do for them. Great story. I don't know if we should have ended with that story. I don't know how you're going to get better, but go ahead and share some other ones.
So another one, a guy recently came in and he had a problem. Like he's seeking financial advice. One, he wants somebody to help him manage his investments. So that's kind of like the core of what we do and how we get paid. But his problem was he messed up his 2024 tax return.
Okay.
He didn't include receiving income from his business.
Okay.
Now,
seems like a major error.
So
depending on the income. Yeah.
Well, I think, he didn't want to get the late penalty. So he filed it like it was, and he needed time to figure out the strategy on how to classify the income that he received from his business. So he pulled out a big chunk. He's got a C Corp. So there's different business structures. And it matters when it comes to taxes. But he needed money to buy a new house. And so it was like a $600,000 transfer from the business to him personally. And when we got to looking at it, we realized that, gosh, like you could classify it as a dividend. Well, then net investment income tax would be a factor. He's over the age of 65, meaning that Social Security or Medicare's already, started for him. So there's the IRMA surcharges. So that's the Part B and Part D premiums for Medicare. So that's a factor. And then there's the long-term capital gains rate for this qualified dividend. So it's 15 or 20%. And his other choice was he could classify it as a salary, but then he's got payroll taxes. And so we were thinking through, okay, what combination of these things makes sense? And if as a C Corp, the corporation is taxed at its own rate. So there's double taxation here, depending on how you structure it.
Right.
If you pay it as a salary, it's a business expense, avoids the corporate level tax. So there's a whole bunch of levers here, and we work to optimize that so that he's got this plan, and actually part of it's going to be a shareholder loan where he'll pay that back over a number of years. He's going to pay for it through increasing his salary. And we're going to try to smooth this out where net investment income tax isn't a factor. We're going to watch the IRMA thresholds.
Right.
And
because it's a loan.
Yes.
Wow.
And
nice.
So
I like that.
Probably going to save him like $30,000.
Wow. Versus just looking at it as a distribution or a dividend or salary.
Oh, yeah.
Because it affects all these other things, like you're saying, net investment tax, surcharges on, Medicare.
That's
wow.
Right. Yep.
That's great.
It may save more than $30,000. So we're still working on it, but
you need like a rap sheet, Justin. Then I save this client X. Like we need to call that client you talked about with the, bringing their tax returns together and find out exactly how much that is and just kind of check that off. That's super cool.
It's things like this where I think an advisor that enjoys tax strategy can really help you. And I think a lot of folks just don't know to ask.
Right.
And for our clients, I'm always trying to think through, like, I know their situation. I know what's relevant and what's not. And I'm trying to think, is there something that we can do to help save you taxes?
That's awesome. I think that's a big takeaway right there, is just to remember to ask your financial advisor or to ask your CPA for the strategy. I think especially CPAs and financial advisors, CFPs, are so high in demand. The supply is not that big. When you're trying to get your CPA to give you strategies on saving taxes when it's tax return prep filing season, they don't have the capacity to do that. And so what I will do is I will meet with my CPAs kind of halfway through the year. They're up for that meeting. We can do some strategies, but I really have to ask for it, right?
Yep.
But if you have a CFP or if you engage CFPs, remember to ask them, maybe find somebody on their team that has a Justin that actually, like he said, enjoys tax strategy. So we really get to benefit that, not just Justin's clients, but the whole team. Are there any other tax stories you want to share before we move on?
I'm writing a book.
Okay.
And so the book it's a tax strategy handbook, and it's just meant to be illustrate a strategy and then give you a little story on how that's helped somebody.
Yeah.
So it'll help people identify opportunity and then kind of point them where either they can do it on their own or partner with somebody like us to help them implement that.
That is super exciting. Man, that's going to be awesome. So let's transition to another thing that maybe folks didn't know that financial advisors can help with, and that's Social Security benefits. So I know for me that there have been multiple times, I'm not directly advising clients anymore, but for over 20 years I did. And when I would sit down with a client, we'd go over their Social Security, and maybe a lot of times this was the example where the husband was the bigger breadwinner, or even the wife didn't really work much outside of the home, stayed home to raise the kiddos, maybe went back to work after, and maybe didn't, and really didn't think that she was going to get any Social Security. And he didn't think so either. Oh, these are my Social Security. And when they learned about that, there's the spousal benefit rule that the spouse can get 50% of, in this situation, the wife would actually receive 50% of the husband. So let's say the husband's was $3,000 a month. And maybe the wife had qualified for Social Security benefits working in high school and college, maybe a little bit, raising kids a little bit after, but maybe her benefit was only $500, that it would be actually bumped up to the $1,500, which was 50% of the husband's. And even if she didn't qualify for Social Security even without enough credit, she would still get this
That's right.
spousal benefit. Yep. So I always, when they fully realized that, it was always such a big like surprise, like a pleasant surprise. Like that's a huge income source that we weren't planning on, that we didn't know we'd get. So I know that's, one of the things that we get to share with clients that maybe they weren't expecting us to advise them on Social Security. There's a lot that comes down into strategy too. Maybe you can share a story or an example of that.
I mean, I was working with a couple yesterday on this, and basically the question is, should they start now? They're 65. Should they wait until their full retirement age, which is 67, or delay to 70, or one spouse start early, or any combination of that.
Right.
And there's some tax planning opportunities here too.
You've got to know what else is going on.
Right. You got to know what else is going on. I'll spare y'all the conversation for today, although I'd love to have it.
Please let them have it.
That'll be in that tax planning handbook that I'm writing. So anyways, when we can model that in our planning software, and at a high level, if you think about starting Social Security early, if you're retired, means that you're taking less money out of your portfolio.
Right.
Okay. Now it's a reduced benefit because you started early, but that's less money that you withdraw from your portfolio. So if you start early, there's this compounding effect year after year where your net worth will be higher because you've taken less out of the portfolio, and that money that you left in there has continued to grow. So your wealth gets bigger between starting early and age 70. But then if you had waited till 70, your benefit would be higher.
Right.
Meaning from age 70 on, you would need to take less from your portfolio. So what we see is that starting early will increase your net worth early on. And then it starts to be a detractor, and it will decrease. It'll start to decrease your net worth later on in life. So I often look at the break-even point when we model this in our software is, all right, it helps at first, and we've maybe got a $250,000 increased net worth because we started early and we didn't have to take that money from the portfolio. But we have a smaller Social Security benefit than we would have if we waited till 70. So now when we get into our 90s, typically, we're having to pull more out of the portfolio to make up for that smaller Social Security benefit.
Right.
And so a lot of times I see that break-even point in the early 90s if you start early versus waiting later. And, nobody knows when it's our time to go, but, that's, I think, leads to an informed decision if people, have mixed feelings about it, and it can help people make a informed decision.
You made a really good point too, that, it's an informed decision. And for our clients, that Social Security is not something we encourage them to make a decision on independently of the rest of their financial portfolio, right? How you're investing, what investments you have, even the age differential on the couple, if we're talking with a couple, all those things can have that will influence and impact the different strategies that you'll go over with them. So that's great. For the sake of time, let's jump down to this question, about how do we help clients with health insurance, right? That I think that kind of throws folks off a little bit. Like, you're not a health insurance broker. No, we're not. We've got one situation where I remember helping one of my clients qualify for a Obamacare subsidy, even though he's a client here and he's a multimillionaire.
Yep.
Right. So I think like listeners, think about that, right? Like, if you're a multimillionaire or maybe you're an emerging millionaire, or a multimillionaire, it kind of throws you off to think that they could get health insurance and get it subsidized. But it's because that Obamacare, Affordable Healthcare Act, is really based on your income, not based on your net worth. And he needed to retire early before he could get Medicare at 65. He was actually he needed to come home. His wife was terminal and he needed to take care of her. So he couldn't work and have a, health insurance at a group plan. He wasn't old enough to have, Medicare at age 65. And so he thought he was going to pay a lot for health insurance, especially because his wife was terminally ill. And so what an incredible thing we were able to do in terms of tax strategy, based on even where that affected where we pulled money for their distributions, right?
Right.
We were relying more on taxable or maybe tax-free distributions instead of the tax-deferred, to bring that income down. So I think that's a really, really powerful strategy and thing to consider and think about with your financial advisor. I don't know if you've got more to say on that.
Now that's a really good point. It's income based, not asset based,
and they can go
net worth
backwards
based.
a year, right? Like you don't have to wait. There's something about that. Like you don't have to wait till this year's over to prove that your income's lower.
Oh no, it's so when you apply, you do have to report what you made in that previous year.
Yeah.
But you put in what you're expecting to make in the year ahead.
Yeah, you don't have to wait till after your lower income year.
No, your subsidy is a tax credit paid in advance to the insurance issuer. So they calculate the subsidy based on what you think your income is going to be. Now you settle up at the end of the year when you file your taxes. So if you say your income's really, really low and it ends up being twice that, be ready because you're going to owe a lot back. But it's a great strategy. And I've helped a lot of clients with this too, where they retired early, or maybe they're kind of in a sabbatical or something like a year or something where maybe they're taking care of kids and have the resources, but don't have the income. So we've gotten really creative with this. We've got one story real quick. There's a younger lady. She's got 3 kids and went through a divorce. She's got assets, or she's got an IRA, but she needed to stay at home and take care of these kids. So she wasn't working, no income, which surprisingly for Obamacare, you've got to have income.
Got to have something.
Some income. So what did? We did Roth conversions, just enough to create the income needed to get the maximum subsidy.
There you go.
So she got nearly free health insurance.
Wow.
Converted money from an IRA to Roth, paid almost zero tax, zero tax on that conversion because she didn't have any other income.
Yeah, her income was so low.
That's right.
Yeah.
And so it was like this.
She realized some capital gains all along the way too for free, probably.
We did.
Of course you did.
That's right.
Gosh, awesome.
Yep. So it's
wild.
It's really important to talk with an advisor about these other things.
Right.
And we're not just here to manage investments. That is the core of what we do, but there's a lot of value. Going back
to the story I shared, that's right. You mentioned that. We actually did have to pull money from his tax-deferred IRAs to create enough income to qualify. Then the rest of it came from tax-free or taxable accounts to keep that income low. Super cool.
Yep.
So as we sign off, let's talk about one last thing, which is how we help clients navigate different life transitions. So maybe speak to that briefly. And
it could be selling a business. If you're charitably inclined, like the time to start thinking about selling the business is before you do it. Unfortunately, there's other, sad stories. If somebody's going through a divorce, then that's probably a conversation that you need to have with a financial advisor. If you receive an inheritance, there's different rules for an inherited IRA versus your own IRA. And there's a lot of tax strategy that goes into that. Trying to think of some other, other examples. You got anything?
You said,
career change,
inheritances, divorce, maybe losing a spouse, selling a business, changing careers. I think those are a lot of the ones that we've done some writing on these too. So you could get on goodwininvestment.com, go to a knowledge center and search on these. We have guides on some of them as well that I think are really, really helpful. Because a lot of folks that are going through those major life transitions generally are finding their way to us. So, and that being said, we do have a blog on this. What you didn't know financial advisors can do for you. So that'll be connected here in the show notes. And Justin, as we sign off, I love for us to take a second to kind of sign off with something that we're grateful for. So while you're thinking about that, I'll share mine. So we've been in our church small group. Like we love church small group. We've been in small group forever. And we with the summer coming, we usually just kind of have a social. We're done with a study we were doing. So we all got together last night, but we also brought all of our kids. And it's just like the richness of life to have like loyalty and longevity with people. Like some of these folks we've been in small group with over 10 years. Like our daughters consider some of their daughters cousins. And I think it's just such a powerful thing to be walking through life with other families that are in similar stages for such a long period of time. So super grateful for that. What about you?
I'll kind of piggyback on that.
Yeah, go for it. Yeah.
Just having a great group of friends and family just it's it's a blessing. So super grateful for all my family and friends.
That's awesome. That's great. Got a shout out, Emily, right there at the end of the pod. Yeah. So very cool. So again, if there's anything we can help you with, don't feel shy. Be encouraged to reach out at goodwininvestment.com. Obviously, you can subscribe to our blog there as well as this podcast. We're on YouTube with some content there as well. And then if you are so inclined and ready to kind of talk more about our services, you can schedule an intro call right through the website. We hope you have a wonderful day. Thanks for listening.
Right.
Bye-bye.
Yes. Thank you for tuning in to the Money Pig Podcast. We hope you enjoyed today's episode. To stay updated on new episodes, be sure to subscribe wherever you listen to podcasts. If you found value in today's discussion, we'd greatly appreciate it if you could leave a rating and review. If you have any questions about the topics we covered, feel free to visit us at goodwininvestment.com and reach out. This episode is produced by evance.net. This podcast is provided for informational purposes only and should not be considered as investment advice, a solicitation to buy or sell any financial products, securities, digital assets, or other investment vehicles, nor as a basis for making any financial decisions. Goodwin Investment Advisory is a registered investment advisor with the SEC, CRD number 131193. Please note that the host and or guests may personally own securities, digital assets, or other investments mentioned in this podcast. Investments carry risk and are not guaranteed unless stated otherwise. We strongly recommend consulting with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategies discussed in this episode. Lastly, past performance is not indicative of future results.